Hey everyone, welcome to question 3 of the Tax217 main exam. So let's skip to the end of the question. Calculate IMA's net capital gain on the sale of business for the year ended 30 June 2017. Okay, so it's only a 7-mark question, but not having read the question, my immediate thoughts are, number one, we need to take into account, if she's had any capital losses previously, is she entitled to the 50% CGT gain? And then on top of that, we also need to consider the small business CGT concessions as well. Is she entitled to this? You don't necessarily just need to be a company to be entitled to the small business CGT concession. You can also be an individual shareholder, provided you meet certain thresholds. And then you should actually be able to get access to certain concessions, like the 15-year exemption, the retirement exemption, and even the small business CGT concession on top of the 50% CGT reduction. If any of that didn't make sense to you, you should be watching our small business CGT videos down below, and also the capital gains video down below. Okay, so let's get started. So we'll have a quick read of the question. So we've got a 60-year-old Australian resident. In 2000, she acquired a coffee shop business for $3 million, of which comprised $1.5 million for the premises, $200K in stock, $300K in plant and equipment, $1 million in goodwill. So she operated a profitable business for a number of years. For the year ended X16, the coffee shop generated revenue of 1.7, made a profit of $400K. The coffee shop also generated the same revenue and profit for the year ended 30 June 2017. So Emma wants to travel the world and leave the workforce permanently. She sold the coffee shop in 2017 for $8 million, comprising of $3.5 million for the premises, $200K for stock, $300K for plant and equipment, and $4 million for goodwill. Emma has no related entities or family. She also has no other income or other assets. All of the assets of the coffee shop are business related. Ignore any capital works deduction for the coffee shop premises. Okay, so there's a number of keyword triggers in here which make me immediately think of small business CGT concessions. Number one, she's close to retirement, which indicates retirement / 15-year exemption. The fact that she's owned the business for a number of years, so she bought it in 2000, and now it's 2016, X6, so that's 16 years later, so that indicates 15-year exemption. It's also talking about like certain assets as well, like related parties, no other income, etc. So that's starting me thinking about the thresholds for the small business CGT exemption for an individual taxpayer. They must have assets under X million dollars. So that's what I'm thinking with this question, so small business CGT concession. So just a few other notes. So when you're dealing with CGT, obviously stock and plant and equipment aren't actually capital gains items. They're treated in different ways. Anyway, so let's do a quick recap of the small business CGT concessions. So you can find that in your notes within the SBE chapter, which is over here. So here we go here. It's a fairly difficult to understand flowchart to kind of understand whether you're entitled to small business CGT exemptions as well. For our quick recap of small business CGT concessions, you get access to quite generous concessions. Basically, the threshold to be able to be entitled to them, number 1 or 2. You're either a CGT small business for the income year, i.e. the business's aggregated turnover is $2 million or less, which we can see from the question it is. It's trading at $1.7 million over here, so they're satisfied on that basis. The other possible way that she could be entitled to small business CGT concessions is if she satisfies the maximum net asset of all affiliate entities. And of course, you only include you don't include stock, you don't include plant. So the assets after you take those two out would be $3.5 million plus $4.5. So it should be slightly over on the asset side, but because the business's revenue is below that threshold, we can actually be entitled for that CGT small business concession. So anyway, so we know that she's going to be entitled to the concession. should start from this checklist from the top. So number 1, CGT event has occurred, which is correct. Sale of the business, CGT event A1, I believe. CGT event would have resulted in a capital gain. So the capital gain in this instance would be the movement in those two assets I mentioned before. So the combined, so the goodwill capital gain would be 3 million, and the premises capital gain will be 2 million. So that would have resulted in capital gains, correct? We know that they satisfied the small business based on the turnover threshold, so that's fine. Number 4, active assets, CGT. So the assets must relate to the business. So they must be used by the business for the purpose of business. So let's just check that. So it says all of the assets of the coffee shop are business related. So that's tick, 1 mark. Okay, so the active asset test is satisfied. Okay, so we know we can pass this off. So now we talk about the actual exemptions that will be available for this person. So the first one is small business 15-year exemption. So people often get confused between retirement exemption and 15-year because the title is actually misleading. Okay, basically, this is the first exemption down here, and it's kind of like a cascading thing. This one needs to apply first. If you don't get to apply it, then you move on to the next one. If you don't get to apply it, then you move on to the next one, and so forth. Even if you do get to apply like these ones, you move on to the next one, and you might be able to stack your benefit. The thing is with the first one, 15-year exemption, if you satisfy this one, the whole gain's written off. So you don't, I mean, technically you're still moving through it, but your gain's already written off, so it doesn't really matter. So basically you stop there. This is the big one. If you can get this one, 100% of your CGT is written off, and it's a really good one to have. So basically, criteria for this is taxpayer continually owns as of 15 years before CGT. We know that she has because in the question she said she bought the business in 2000, which means she's held it for 16, 17 years, which is greater than 15 years. So per section 152, she's satisfied this criteria. If it's an individual, and is the individual greater than 50 years, and did the event happen in connection with individual retirement or permanent incapacity? So we know from the question that she is over than 55 years old, and it is connection with her retirement. She plans to not ever return to the workforce. So in this case, they would actually be written off. Hence, this connection to retirement being a criteria is why people get confused between this 15-year exemption and the retirement exemption later on, which the retirement exemption doesn't actually relate to retirement. See, no need to be retired. It's pretty confusing. But yeah, just look at your notes. And that's basically it. Because she's met those criteria, we actually get to write off the entire amount of her gain. And that's basically it. So her net capital gain is nil. So I'm not going to write this down, but to get the 7 marks, you have to go through that same thought process that I just explained verbally. So it's basically just identifying that there is a gain, going through those events that we mentioned before, identifying that there's no capital gain on stock and plant because they don't fall under CGT provision. We need to identify that the small business CGT concessions are actually qualified, and that's basis on turnover being under the $2 million threshold. And then we have to identify that she's actually satisfied the 15-year exemption criteria, i.e. she's greater than 55 years old, the assets were held for 15 years, and it's in connection to her retirement event. If you can go through all those steps and then conclude that the net capital gain is nil, then you can get a 7 out of 7. I'm not going to write that down, but that's basically what you do in the exam. So let's move on to question 3, part B. So in this question, we've got an Australian resident. Actually, let's read the requirement. So calculate capital gain. So it's another capital gain question. Capital gain before discounting or loss for each of the items above for the income year ended June XY7. Provide the key section reference for each item. Okay, so this is one that I am going to set up in our workbook. So question 3, part A, not written down, refer to video. Part B. We're going to copy this template over here. set up your workbook nice and neat. Makes it easier for the marker to give you full marks in your question. Okay. Alright, so let's just write these down. What's the first thing that we have to do? So we're basically going to write a list of all the 7 items that we've got here. The first one is family, boat, rental property, vintage car, shares in CFC, received comp, defamation case, excuse my spelling, 30k lottery win, diamond ring sale. So in this question, it's going to be testing us on the usual capital gains stuff, like think of all the collectibles and think of all the exemptions in here. So we got to, in the general process, are there any capital losses to apply? Do they get the 50% CGT? Is it pre-CGT? Is there any modification of the cost base? And then exemptions, which we can talk about in this one over here. Is it a pre-CG asset? Does it relate to a car, motorcycle, etc.? Is it a collectible? Is it a personal use asset? And so forth. Does it fall under a different provision other than capital gains? We don't apply capital gains. So that's basically what we have to do in this question. Let's jump into the first one. So I'll just bring the exam paper up. So the first one is the family boat. So they acquired it for $1 million in 2019. They got 800k sale in this year. The first one for the boat, the approach I would take is I'd have an idea in my head as to what I think it is. Like, do I think it's a collectible? Do I think it's a personal asset? Do I think it's a vehicle? Whatever it is, have that thought in my mind, and then just double check it in your critical file notes. So in this case, it could really only be 2 things. It's really only going to be a vehicle, or it's going to be personal use asset. It's not going to be a collectible. So it's not a vehicle because the category isn't actually specifically vehicles. It's actually specifically defined as cars, motorcycles, valor, bravery decorations. So a boat it's obviously not a car or a motorcycle, so it's not in this category. It's not pre-CGT. Therefore, it must be a personal use asset, e.g. boats, planes. It's even got an example on there. So it's basically CGT is ignored when $10,000 or less. So there's, if it was a capital gain, we wouldn't, there would be an exemption if it was less than $10,000. However, no capital loss for personal use asset can be used to reduce gains. So basically what we have to do is even though this is a capital loss of 200k, the capital loss is actually disregarded. So what we might put in here is also an explanation category. So cap loss disregarded for personal use assets. Section reference, include this. Go to our ultimate notes. Pull in this section reference here, section 108-2. That's good. Bam, done. Question 2. Rental property in Melbourne for $2 million. Property was acquired in 1984 for 200k. So as soon as you see 1984, that's a very old date. As soon as you see those really old dates, you're thinking pre-CGT, right? So let's just confirm in our notes what the CGT date was. I think it was 1985 from memory. But that date there is definitely pre-CGT. Oh well, I'm not going to spend any more time looking for it because that date's obviously pre-CGT. Anyway, pre-CGT gain disregarded. So here we go here, pre-CGT asset, section 104-1. We're going to copy that in there. Wrong cell. So again, this is going to be a 0. Next one is a vintage car. So cars, it doesn't matter if it's vintage or not. That's just a trick question to get you to think it's a collectible. It's a car. It's always going to be a car. Section 118-5, it's always disregarded. So again, 0. Section 118-5. There's our explanation there. Okay, this is pretty easy so far. Next one is shares in a foreign company. Let's just have a look what happened in here. So they sold shares in a 100% active foreign-owned company, 100k. Sorry, 100% for 500k. The shares were acquired in 2012 for 400k. So therefore, there's a capital gain of 100k, unless there's some sort of exemption that we could apply here. So let's just go ahead and say 100k capital gains. Put that in there. Next question is, can we get like a CGT discount or some other exemption here? Okay, I just realized something from reading the question again. Before discounting. Okay, so this is something that you could easily get tricked. I got tricked immediately. This is why we pay so much attention to just reading the question and seeing exactly what it's asking you. Another example before is when question 1 of this exam paper, when it was asking us specifically for the decline in value expense. And that actually meant that we didn't need to include the R&M expense. And if anyone who had in that exam process who had included the R&M expense would have lost the mark for that. Even if they had just written 0, they would have got the mark. Because whilst, yes, they would have incurred an R&M expense, the question was only asking for decline in value. Therefore, if you didn't provide that exact answer, you wouldn't have lost the mark. So this is why I always focus on the exam question first. Read it, check it as I'm going through it, check it at the end as well. Because you need to be super precise and answer exactly what they're asking. So before discounting. So whilst technically we would have reduced that gain by 50,000, so 500 to 400 less 12-month CGT discount, bring it down to 50k. We only want to include it up. We only want to include the gross gain before discount. So just be super careful with that. All right, next one that we're going to look at is the compensation payment of 60k for winning a work-related defamation case against a local newspaper. So 60k compensation payment. So generally any windfall gains are disregarded, and this is definitely the case for a lottery. We can see that in the notes, say windfall. So here we go. But there is a different type of compensation, so it's different to just windfall gains from lottery, which is number 6, so that's definitely going to be disregarded. But this other one here, compensation payment, we need to be careful that it doesn't apply to one of these. So like compensation of damages, gambling, competition win, because depending on what it is. So compensation of damage is treated as revenue, accessible under section 6-5, if it's trading stock or a depreciation asset. For example, if you lost trading stock and you were reimbursed for it, that would actually be accessible income. However, if it's just an isolated gain, don't disregard this gain. In fact, I think it actually is specifically listed under section 118 as something that's exempt. So defamation under section 118-37. But even if it wasn't specifically listed, because it's not related to trading stock or depreciating assets, it wouldn't be treated as accessible income anyway. So let's include that in here. So again, this is going to be disregarded gain as compensation, not trading. Okay, next one is 30k lottery wins. That's definitely disregarded. We know that for sure. We know windfall gains. Where do we see windfall gains? Windfall. Here we go. Section 118-37. Specifically disregarded gain as windfall. That's also going to be 0. So basically I haven't had to pay anything so far except for the shares in CFC. Okay, the last one is the diamond ring sale. So a diamond ring could be a collectible, potentially. That's what I'm thinking. So we go up the top and say our collectibles acquired on $500. So specifically, we need to be careful in terms of what this actually includes, because it is quite specific definitions, and just because it sounds like a collectible doesn't mean it is a collectible. So it includes artwork, jewelry. Okay, so jewelry, that would be the case here because we got a ring. So how much did they actually pay for it in the question? They paid for it for less than $500. That's cool. It's after CGT was implemented in 1985 as well. So just be careful with that. So it actually is a CGT event. But because it was a collectible acquired for less than $500, let's see what it says here. It says CGT ignored when acquired for $500 or less. Cool, so we can actually disregard this gain. You copy across the section reference as well into our answer. Collectible acquired less than $500. This is 0 as well. So the total gain, actually let's just check the question and make sure that we're answering it exactly. So calculate capital gain for each of the items above for the income year. So I don't think we need a total here necessarily. It's just each individual item which we've done, and we've provided a key section reference for each. Okay, cool. So that's 7 out of 7 marks. So let's keep going with question 3. We're now up to part C, which is worth 6 marks. And again, it's another capital gain question. It's saying calculate the capital gain or loss for each of the assets above, provide the key section reference for each. Calculate Sensei's net capital gain, if any, and net capital loss, if any. So same process as before, but it is to do with the fact that she ceased to be an Australian resident. So that's to do with the CGT event, where if you actually cease to be a tax resident, there is a CGT event as a result of that, and depending on the type of asset will impact like the tax implication for it. So first of all, let's check how many items we have to address in this question. So we've got 5 here, so we'll make sure we've got 5 responses here. Let's read the question exactly so we know what it wants. So capital gain or loss for each, provide section key reference, and then also calculate the total net capital gain, if any, and net. Yeah, okay, cool. So we're going to need a total at the bottom as well. Alright, let's get started with the first one. Actually, let's do a quick recap of what happens when you actually cease to become an Australian resident. So let's go to our notes. So what happens is, the situation we've got here is we've got a resident who becomes a non-resident. And basically what happens here per section 104-160 is that there's a capital gain loss on assets that's not TAP. TAP is taxable Australian property. So it's going to be land, buildings, etc., things like that. So land, buildings, etc. doesn't trigger a capital gains event. Everything else that they own does trigger a capital gains event. So CGT event L1 deems a disposal of all CGT assets per market value at the time the individual stops being an Australian resident. Exemption under section 104-165 to disregard all gains and losses until other CGT event occurs. Taxpayer becomes Australian resident again. So you can actually defer your gain if you want to until one of these events. And also it doesn't apply to any pre-CGT assets as well. Okay, so basically what happens is we need to look at the assets one by one and say, aside from property, you know, we need to trigger a capital gains event basically. So first one that we need to trigger is she's got a New Zealand flat. So basically what's going to happen is, trick here is her New Zealand flat taxable Australian property? Well, it's actually not, okay, because whilst it is property and whilst it is taxable, it's not Australian, it's in New Zealand. So that's a trick question. A lot of people would have got caught out in this exam and thinking, yep, that's TAP, no CGT, but actually there is CGT because it's outside the Australian tax net, so that's unfortunate. So basically what we need to do is we need to calculate what a capital gain is. So it's going to be 800k is the market value, and that's what she's basically, the triggered event is. So the apartment was acquired for 600k, so it's basically going to be 800k minus 600k equals your gain of 200k less your 50% CGT discount, and just make sure on the question that it's asking us for the net, which it is. Okay, so it's not just asking us for the gross gain. So I think just to be safe, because they have this split this out into 2 different parts, and we're not exactly sure whether they mean that on a, like just doing it on a total level, or do they mean for each individual asset do the capital gain and the net capital gain. I think to be safe, let's do both. You just like, if you're not sure, you just don't want to risk it just in case, you know. So what we're going to do down here is we're going to go capital gain, net capital gain. So her gross capital gain is basically going to be equals 800,000 minus 600 1,000 is going to be 200,000. But she also gets access to the 2,000. She gets access to the 50% CGT discount. And the relevant section reference for this is basically this one over here, section 104-160. Basically, when she becomes a non-resident, anything that's not taxable Australian property, when she becomes non-resident, actually I'm just going to copy and paste it rather than type it out. Okay, so I'll just paste this in, but of course you need to kind of write your own response in the exam explaining it. Okay, the next one is, the next asset she has is her coin collection. So it's got a market value of $300,000. The coins were acquired in 2010 for $350K. So she's got a negative $50K coin, and it's not taxable Australian property. So you should actually trigger it. So she'd just right here, loss. So she'd actually have a negative, was that right? $50,000 gain? 50,000. Yes, should have 50,000 gain. So the next thing to consider is, are there any exemptions? Because we're talking about coin collection, so that sounds like, you know, valuables, collectibles, etc. So whenever you see something like that, make sure yeah, is there an exemption for that? So if we scroll at the top of our notes and go to collections. So collectibles acquired for under $500, blah blah blah. But any capital loss is quarantined and only offset against gains against collectibles. So actually, there's no loss. Loss from collectibles quarantined. Actually, I'll just copy these two. That's basically how you answer your question for number 2. Okay, moving on to number 3. We've got trading stock shares with a market value of $900K. The shares were acquired in August 2016 for $860K. So she's held the shares for market value of $900K. The shares were acquired in August 2016. However, the issue is, right, if it didn't say trading stock right here, it would be pretty simple. It would be 900K less 860K equals 40K gain. You know, do your 50% CGT discount, that's 20K net capital gain. However, it says trading stock right there. That's a trick question. Now, remember, anything can be trading stock, right? Even shares. It just depends on how you're using it. For example, you could be a professional share trader. If you're a professional share trader, then your business is share trading, and therefore your trading stock would be the shares. However, if you're just a individual personal investor, do the occasional long-term trade, that's on the capital account, and then we would do the capital gain. So trading stock is not on the capital account. So there's actually no capital gain. So we just need the section reference now. Trading stock section 11825 is not applicable, does not generate capital gain. Let me just copy that. Trading stock, no CGT. Shares as trading stock. So that's nil. Okay, next question that we've got here. So she's got a factory in Australia with a market value of $1.2 million. The factory was used to derive rent. The factory was acquired in 2013 for $800K. So is this taxable Australian property? It sounds like it. I mean, it's in Australia. It's property. It's taxable. So in this case, yes, that she's got a gain of 400K, but basically it doesn't trigger a capital gains event because it is taxable Australian property. So factory in Australia. So let's just double check this against our notes, make sure we're on the right track here. Let's go back to the section to do with where individuals become non-residents. Here it is here. So the section reference will be section 1046-0. We can just say TAP, taxable Australian property. That's fine. You might want to fill out the full answer and actually say, maybe in question marks, in brackets, something like that. Otherwise, that's going to be just a 0. And then finally, we just got, what's our last asset? Wine collection for personal consumption. Market value of $12,000. It's a personal use asset, acquired for $9,000, selling for $12,000. So it's $3,000 gain unless there's some sort of exemption. So let's just put this in first. Wine collection. I'm just going to put in the 3,000, and then once we find the exemption, if there is one, then I'll remove it from my answer. So let's go up the top. Let's look up, so collectibles acquired. So how much did they acquire it for? So the wine was acquired for $9,000 in 2013. It's personal use asset. Oh, here we go. Here, personal use asset acquired for less than $10,000. Ignored when acquired for less than $10,000. So we ignore this under section 118-10(3). Okay, cool. So that's basically it. So those are going to be $0 because it's exempt, and that's how you answer this question. And you know, we can still do a total because at the end of the day, we've covered our bases because we've got the net capital gain column, and we've also got our total column of all of them. So that's pretty much it. That's how you answer. That's how you answer this and get a full 6 out of 6 for this question. So and that's also the end of question 3. So thanks for watching. Look forward to seeing you in the next video where we can talk about question 4.